What's next for markets?
I'm Michael Kantrowitz, Chief Investment Strategist at Piper Sandler, where I lead the portfolio strategy team, recently ranked #1 on Wall Street in the 2024 All-America Institutional Research Survey.
Hello, Michael. It's been a very difficult week for investors in the market on the news of tariffs. I think investors would love to hear what your reaction to it is. We know what the market's reaction was.
Yeah, hey, Stephen. Yeah, you and I were traveling last week, seeing clients throughout Texas and Kansas City, enjoying barbecue. And that was the highlight of the week. But other than that, it was a quite ugly period, but a good time to be in front of clients and discussing the market reaction, the news of Trump's tariff announcements, and what we're watching in terms of where we go from here. So our initial reaction on April 2nd, that afternoon, we published a note with clients and highlighted 5 different things that we felt we had some visibility and conviction on or understanding of in this backdrop. The initial one was that just highlighting that prior really to 4/2, those tariff announcements, there really wasn't a tremendous amount of macro risk priced in. And we talk about that, and there's something, a theme of ours we've been highlighting for a while, was that when we looked at credit spreads coming into the year, they were super, super low. The market was pricing perfection and Goldilocks. And up until April 2nd, yes, risks started to get priced in, or I would say uncertainty started to get priced in. And that was after earlier in the year, as the markets first started declining on the growth slowdown, on the DeepSeek news, on things like Walmart earnings. The markets went from pricing in Goldilocks to pricing in some economic uncertainty that got compounded by tariff uncertainty. And then we got to 4/2. And since then, we've clearly started to price in a lot more macro risk as we now have an idea of where these tariffs are going to be. So we look at things like credit spreads. We have shot up pretty sharply. We're not yet above any prior levels we had seen in 2022, near the lows of the market in CPI, or even in 2016, earlier in the year, when oil prices and emerging markets were getting hit hard, or even in 2018, where the Powell famously pivoted, which put it at a bottom in the market. So when we look at high yield credit default swap pricing right now, that's at about 440 basis points. It started the year around 300 and really doubled since April 2nd from where it was. So the real big move has been in the last week. So now we are pricing in some risk, and we think that's going to stay somewhat elevated. Whether it goes higher from here will be really a function of the headlines, but we do expect trade uncertainty still to remain very high. Yes, there'll be some news in the weeks ahead that'll probably whipsaw the markets and investor sentiment. Beyond there, inflation uncertainty is going to remain high. All the data we saw in the prior month or two of consumer and business inflation expectations rising will likely continue. With respect to the Fed, Powell was quite clear last week that they see no reason to jump into action and cut interest rates right now, which I think makes sense because there's nothing really broken in the plumbing of the financial system. And the most recent employment data point was fine. And now the new piece of uncertainty that is going to rise in the weeks ahead is going to come during earnings season. So those are the few initial takeaways after April 2nd.
So something we've talked a lot about in the podcast and our written work is we came into this year priced to perfection. And now we still have economic uncertainty and earnings uncertainty to digest. What could go right?
So, Stephen, I think there's a long list of things we can think about that in terms of what could go right. I think the what could go wrong list at this point almost very obvious, and investors are starting to extrapolate slowdown to recession. I've even heard people mention the word depression. This is what happens when stocks go down. They take a problem, an initial problem, and then extrapolate it. And that's why you have bear markets ultimately, because even though we've seen, I don't know, dozens and dozens of bear markets throughout history, and they all end, investor behavior gets sucked into that fear backdrop, just like we have market bubbles and greed takes us there in cycles. I think Andy LaPerriere, our global policy analyst, who's really nailed the tariff story and has been arguing that Trump is going to do what he's been saying, he talks about 2 different things that could really whipsaw markets in the coming weeks. One is the idea that we're going to start to see some deals now that he's kind of laid the table for here's what I want to do. And so perhaps we've seen most of the negative news coming from Trump. Obviously, retaliatory actions could escalate that, but we kind of know his plan. So any kind of trade deals will likely create some potential upside volatility in the market. That could be a positive. The second thing that Andy mentions is that he questions the legality, and many are questioning the legality of what Trump has done, whether he has this ability to just broadly carte blanche authority to impose all of these tariffs. And Andy highlights that we could start to see more challenges from the courts in terms of Trump's legal authority to impose all of these tariffs across the world. And so that could be a source of good news if the use of Trump's use of IEEPA to impose these tariffs is deemed illegal or thought to be illegal. And Andy even believes that it could eventually get reversed by the Supreme Court. So if investors start to hear, oh, maybe these will get held up, that certainly would be a positive today compared to what the market is extrapolating. Other things that I'm just thinking of that could create some positive here, besides, again, any positive good news on tariffs, right? The rest of the world is now getting sucked into this. Global markets are all resyncing. We're seeing the European markets, which had done so well at the beginning of the year, have given back a lot of those gains. So perhaps whether it's European markets or even some of these really hit emerging markets, like we're seeing Vietnam, begin to fold pretty quickly. And that's not surprising. These smaller, high export economies just cannot afford this whatsoever. So that's going to be, I think we're going to see more of those. Whether that's a big enough positive to at least stabilize the market will be seen. Last week's jobs report was fine. So there's really no reason for the Fed to jump in at this point. But perhaps the jobs data going forward actually is not as weak as expected. And you can look at that two different ways. But I think there's this view that where the economy is going to be in a recession next month. But under this cloud of uncertainty, companies may just delay doing anything. As they learned after COVID, rehiring people after firing them is pretty difficult. So we may not actually see as sharp of an employment downturn as quickly as investors are expecting. And so that's a positive for the economy. Perhaps it's a negative if you think that you want the Fed to cut, but we'll see how that goes from there. Obviously, interest rates are down a lot. Oil prices are falling sharply. And we did see on Friday a lot of the home builders and a lot of early cyclical stocks that benefit from lower interest rates and lower oil prices start to see some positive moves. You saw some huge upside moves in these home builders. And if we end up continuing to move towards this recessionary backdrop, rates will likely keep falling. And the next leg of outperformance heading into recession is usually these more early cyclical stocks that benefit from lower interest rates. So in terms of positioning, I think part of that is what may be going on underneath the surface. And then on the policy side, we may hear from the Trump administration the rhetoric change to U.S. tax cuts and deregulation. So again, none of this on its own is going to stop the problems that these new tariffs could create, but it could help shape the sentiment and change the sentiment of investors that are wholly looking at really negative outcomes today. Markets could fall so much that something starts to break and the Fed has to get involved. In that case, we have a bigger problem than tariffs, whatever breaks, and then the Fed has to respond in some form or another, and that could cause a rebound. So the point is that markets never go straight down in a straight line, and uncertain as we are today that we're going to have this negative outcome, sentiment never stays the same and things never stay the same. We just want to be on the lookout for some positive catalysts or potential catalysts that could stabilize markets or even cause a rebound in stocks that could last several weeks or even a month or two. Again, there's a lot of negative news now, and I don't think very many are looking for what could arrest that at least in the near term.
You expect continued volatility, and it's very difficult to time these peaks and troughs. But you do have a lot of people out in the marketplace talking about things like the bearish sentiment in AI and how that is in the upper percentiles of historical readings, and how valuation now in the 18s has come in so much. Any thoughts on valuation, earnings, sentiment right now, and what that may mean for future returns?
Sure. Yeah. I'll give you a quick story, a lesson I learned that sticks with me today regarding sentiment. So I remember we were working together, Stephen, back in some point in early '08. And I remember doing a study on consumer confidence. and forward returns when consumer confidence was really depressed. And we had gotten down to one of those levels. And I remember we probably wrote a note on it and showed, look, consumer confidence is down to these levels. The next 3, 6, 9, 12-month returns are really good. And the lesson learned there is that while that historically may be a contrarian signal on average, at the end of the day, it's somewhat more of a correlation than a causation, meaning that what happened certainly in '08 is the problem, rising unemployment, falling home prices, bankruptcies, continued to get worse. So while people were very depressed with respect to their sentiment, ended up not being a good contrarian signal. So I think that a lot of those studies tend to work much better in like 5% pullbacks, which don't really have a major macro concern that necessarily led to those, where you get some oversold indicators, things like that. But when you're down 10%, there's usually a problem, or 10% or more. And we've been highlighting for several weeks now that while these sentiment measures are really negative in AAII, that they're just completely out of context, at least up until last week, of other periods where AAII was very negative. And so the other comps to past periods would be the bottom of the market in '09, the bottom of the market in 1990, the bottom of the market in early 2003. And yeah, the sentiment today is as bad as it was back then on that metric. But back then, we had a market that had fallen much more. We had massive stimulus that followed from the Fed and in some cases, our fiscal authorities. And yeah, that gave us this massive rebound in the economy and the stock market. And that's just not where we are today. On valuation, we've seen the multiple come down to 18. But if you think about the uncertainty that's gone up alongside that, how can we even pretend to know where the multiple is in the market? So for example, I remember in late '07, I think the S&P at the high was trading at a 14 times multiple. This is an extreme example, but it makes the point, which I like to do. It was trading at 14 in early October of '07. The market's at a high. And by no means would anyone look at that market and say, look, it's expensive. If we had perfect foresight, which of course you never do, what the PE actually was at the time when we actually got those earnings for 4Q was something closer to 19 or 20. And so today, if we look at the PE and say, well, it's 18, the issue with that is that it's probably a lot higher because forward earnings estimates for the S&P 500, which today stand at about $270, have not come down at all. So that 18 multiple is assuming that we're going to get the same earnings estimates that we were basically analysts were expecting a month ago or almost 2 months ago. We've seen near-term earnings estimates for Q1 come down, but for the out quarters, nothing's really changed. And that makes sense. Again, there's not a lot of clarity on what's going to happen, and companies are going to react, then analysts will react, and those estimates will change. And that'll probably happen this coming earnings season. But right now, if you shaved off 10% from those earnings, the multiple goes right back to near all-time highs. So I don't think valuation is going to save the market here, and nor is it a useful signal. Fair value is a function of sentiment. It's certainly not a rule. And as the uncertainty has increased, the usefulness of valuation metrics has sharply declined in recent weeks. And we've seen the VIX shoot up above 40 last week. And again, any study you do shows that on average, when the VIX is above 40, market returns in the out months and quarters are really positive. To quote Family Guy, what grinds my gears is that rarely the people that show those studies show the variation around those outcomes, that sometimes the returns are actually really bad in the next 3 and 6 months. The averages look good, but the individual episodes show a lot more uncertainty than just showing this really good average number suggests. So I would caution anyone that's reading those studies and saying, well, look, this is a green light. It always works on average. Well, averages rarely play out, and just something to keep in the back of your head. So ultimately, the markets will, we believe, bottom when we've hit a point where we start to get more positive trade rhetoric versus more negative trade rhetoric, similar to past downturns in markets. 2023, the market bottomed when interest rates stopped going up, which was clearly dragging down the market in the summer of 2023. In 2022, where again, people were really freaking out about the economic implications of this sharp rise in inflation post-COVID and the sharp tightening cycle that was to come, talking about a recession. And if we look back at 2022, there were really 2 points where the market stabilized. The first time was in June of 2022, where oil prices peaked and started falling pretty sharply. And that caused a huge rally in the subsequent month or two. But then the market did roll back over, hit a new low in October, which was ultimately the bottom when we started seeing positive data from inflation. And so, in a sense, think of June 2022 in today's parallel to like maybe we get some good trade news and it stabilizes the market. But ultimately, if the problem keeps getting worse and that's followed by more retaliation and Trump really taking a hard line and digging his feet in, it could suggest that it's not ultimately the low. There's a lot of interesting parallels we can look at in the past from different bear markets, but that behavior of extrapolating the bad news, getting excited about changes in positive good news, causing a rally, and then perhaps seeing a new low is something you often see. And so ultimately, yeah, this is why it's, of course, really difficult to time markets, and ultimately why we continue to suggest that investors tread lightly. Those that have to be invested, i.e. our clients, really continue to focus in companies that are best of breed, have strong fundamentals, good visibility, that will weather this storm if it does continue, which we don't think we're going to see a 180-degree shift in the story quickly or necessarily in the near term.
Thank you, Michael. This has been very helpful.
Thanks for tuning in to today's episode of What's Next for Markets. Please remember to check out the episode notes on our website, what'snextformarkets.com, for charts related to today's show.
We hope you enjoyed today's episode of What's Next for Markets. You can subscribe to the show on Apple, Spotify, YouTube, or wherever you get your podcasts. Be sure to follow Michael on X at Michael Cantro. If you like the show, please let us know by leaving a positive review. The preceding commentary is not financial advice. You should always seek appropriate financial advice from a professional financial advisor in your state. You should not consider this as a substitute for these services. Piper Sandler does and seeks to do business with companies covered in its research commentary or coverage. As a result, investors should be aware that the firm may have a conflict of interest that could affect the objectivity of this commentary. Investors should consider this commentary as only a single factor in making their investment decisions. For full disclosure information, visit www.pipersandler.com/researchdisclosures.